And joining us now on the line from New York, New York, Henny Sender, correspondent with the Financial Times. Henny, you look terrific for someone who probably hasn't had 2 hours sleep over the last week and a half. How are you doing tonight?
I was just saying that I came back from China early to watch this financial crisis unfold. China, of course, is saying, we thought you were supposed to denationalize the financial systems.
Well, you're going to draw us through all this right now because let's start with the latest news. Goldman Sachs and Morgan Stanley, two of the biggest names in investment banking, are left standing, but they're no longer doing what they were once doing. They're now called bank holding companies instead of investment banks. What does that mean exactly?
Well, they've torn up their business model. Not long ago, the wisdom was that if you were a bank, a commercial bank, you were a pretty boring institution. You took deposits in and you lent them out, and that was about it. And all the excitement, all the sexy stuff was done by the investment banks, doing these high-powered capital market deals. They were the masters of the universe. And all of a sudden, people are saying, you know what? In an unstable world where funding can disappear in an instant, deposits are really a good thing to have. So investment banks really ought to be more like commercial banks and have access to cheap funding, which they get from people like you and I, individuals who give their money to banks and don't get paid a hell of a lot for them, but aren't liable to pull them out at a moment's notice.
So the sexy stuff is gone now.
The sexy stuff is going very quickly now.
Very quickly. How did the investment bank model, as it were, break so spectacularly over the last little while?
You know, it is a weird thing how quickly people decided we don't like this model. I mean, even on its earnings call last week, you know, what Goldman was doing was making an impassioned case for its business model. You know, Goldman will remind you, even in this last year, this last tumultuous year, our return on equity was 20%. That's pretty terrific. Our balance sheet is really, really healthy. We don't have a lot of need for equity. We don't have a huge capital hole on our balance sheet. But the markets were in no mood to listen. To some extent, Goldman was the victim of its much weaker peer, Morgan Stanley. And the market said, we don't want to hear any of this. We just think you ought to have stable deposits behind you. So Goldman's attitude is, we're agnostic. If that's the perception, then I guess we have to tear up our own model and get a new one. And it'll be a tough transition, but for sure we'll come out on top at the end.
Let me get your sense now about this new mother of all bailout packages that the administration has put together. This package will apparently commit taxpayers to buying, what's the latest, $700 billion worth of troubled loans and other mortgage-related securities from banks and Wall Street firms. How exactly is this going to work?
No one knows exactly how it's going to work, and no one even knows whether $700 billion is the right number. The last time we had a debacle, the savings and loans crisis, which is a small fraction of the cost of this one, at the beginning, they were way too optimistic in the estimates of what it would cost. I mean, this $700 billion could easily balloon to twice that much, and the sad thing is, no one does know how much it's going to cost or how you go about pricing the things that you're going to buy. You know, this crisis is so much more complicated than the last one. In the last one, the RTC bought up banks and sold all the assets. This time they're saying, give us these assets at some price on a yet-to-be-determined formula, and hopefully we will buy it and introduce some liquidity. But there are lots of problems, because if I'm a bank and I'm selling this stuff below what I think it's valued at, my hole on my balance sheet gets even bigger.
Well, and it goes beyond that. It's interesting how when you start giving out hundreds of billions of dollars worth of taxpayers' dollars, it's amazing who will line up for a handout. And I wonder whether Washington has got the guts. This is, after all, going to be a political decision at the end of the day, not just a financial one. Does Washington have the guts not to include some people who are out there begging to have their bad debts purchased as well?
Well, you just don't know where it is going to end. I mean, if you are a troubled car maker in Detroit, you think, hey, why shouldn't I get some help as well?
How important is the flow of credit to the general economy? I mean, I guess I want to get a sense about whether or not, are we talking about just a full-scale financial collapse without it?
Well, Hank Paulson, when he says the alternative to this is, depression, I'm paraphrasing him obviously. I mean, credit is the lifeblood of an economy. The lesson of the Japanese financial meltdown was you can't separate the financial meltdown from the real economy. Companies need money and they get money from the banks. And if they don't, the whole economy grinds to a halt. You cannot separate the financial world from the real economy. Every company in America is hostage to financial institutions. So no matter how much trouble you have accepting this bailout, I think Hank Paulson is justified when he says the alternative is even less palatable.
Well, talk to us about the alternative, because obviously taxpayers are not thrilled with the idea that they're going to have to bail out these people who made reckless and bad decisions on the assumption that the housing market was just going to continue to go up and up and up. What's the alternative to not bailing them out?
If you don't bail them out, then you don't see any credit extension, and companies will have trouble keeping, the workers that they have on their payroll. They're facing rising commodity costs. They need credit because not all of them can fund whatever they do in the world just on their cash flows. And so you will really trigger a depression if you don't get money flowing through the system. The art of it is, how do you punish the people who got us into this mess and yet restore the financial system to something resembling health? And it is a very, very tricky challenge.
Well, I wonder if part of the punishment might be, and we've seen this suggested in some newspaper stories today, can you say, you take over this company, and you got to work for $150,000 a year, not $40 million a year like you guys are accustomed to working for? Can that be part of the, the strings that come attached?
I think it's going to have to be. I mean, the whole governance model is broken. When these corporate executives ran their companies into the ground and walked away with payoffs of tens of millions of dollars, you've got to say there are problems with the system, and the whole corporate governance system, as well as everything else, is open to question now.
The Federal Reserve, I guess, was for the most part, or looked over the money supply, played the referee in this game. They're now a player. They are now a massive player in the banking business. Did anybody foresee their role changing in the way it has over the last 2 weeks?
When you look at what's gone on in Washington over the last few years, you don't have a lot of confidence in the regulators, quite frankly. And I'm talking about both the Fed and the SEC. I mean, you could argue that the Fed got monetary policy wrong, that it kept interest rates too low, too long, and led to this frenzied search for yield. And they also abdicated their responsibilities in guaranteeing financial stability by not saying to the banks, you cannot keep all of these contingent liabilities off balance sheet and not hold capital against them. So, the idea of a Fed which closed its eyes and spoke openly about let the free market play, and you had a federal central bank governor who doesn't believe in regulation, and now you've given them extraordinary power. It is very troubling.
Okay, let's look at the third pillar. We talked about Wall Street. We talked about the regulators. Let's talk about government. And to that end, I want to read a piece here from Chrystia Freeland, your colleague at the Financial Times, who wrote, on September 15, 2008, the Reagan era officially came to an end. The sunny confidence in the superiority of the American way has been undermined now, not only by Guantanamo and Abu Ghraib, but also by the fact that this financial crisis has its epicenter on Wall Street, not Moscow, Mexico City, or Mumbai. Even more importantly, after nearly 3 decades when the prevailing promise was to make government smaller, the focus now will be on making government better and probably bigger. Okay, as we look at that third pillar, how much does government get the blame for what's transpired over the last few weeks?
I mean, I think the government is hugely to blame. I think it was very far behind the curve, very reactive. I think in defense of them, though, you might say, you know, if Paulson tried to float this package weeks ago, no one would have listened to him. So it is very hard to apportion blame in the middle of this firestorm. However, you know, from my point of view, the thing that I had the most problem with was the federal government and the Federal Reserve's position that you can't know when there's a bubble. I mean, perhaps because I lived in Japan for all the years of its bubble, you would see these graphs and they would show incomes rising very slowly, and then you would have house prices rising astronomically quickly. But you need rising income to support those housing prices. I think it's clear that you can say there is a bubble. I don't know when it breaks, but at some time it inevitably will. And that's why at the moment, I think Governor Shirakawa of the Bank of Japan is really the governor that has the most insight. And I listen to him with a lot of respect because he has scar tissue that I think the federal regulators in this country are only just beginning to acquire.
Henny, let me get your take on what, I don't know if you've heard of this financial blogger named Barry Ritholtz, but he's been writing about the different kinds of troublemakers in this thing. Lehman Brothers, he makes the analogy, are like the kid pulling the tail of the dog. Bear Stearns is like the little pyro, the kid who's always playing with the matches. And then AIG, the insurance company, is like the kid who accidentally stumbles into the biotech warfare lab, finds all these unlabeled vials, and then heads out to the playground with a pocket full of that stuff. Obviously, the regulators, the governments, have made some decisions about who to try to save and who to let go. They let Lehman Brothers go. They tried to save AIG. Why the distinctions?
I think that if you looked at AIG and you looked at that $440 billion of protection they sold on these weird, structured, complicated financing, it's all about the law of unintended consequences. This is fairly complicated, so bear with me for a moment. Regulators in Europe said to European banks, you're investing in all this really, really complicated paper, and you better set aside capital in case it loses its value. But if you have hedges, if you buy protection against losses, you know what? You don't need to carry capital against this. So all of these European banks bought $300 billion of so-called insurance from AIG. If you had wiped out AIG, that would have gone to zero, and all of a sudden, European banks would have had $300 billion in capital shortfalls. So you really could not afford to let AIG go. And one small footnote here, in return for guaranteeing $440 billion worth of these now apparently toxic securities, AIG recorded a profit of only $156 million in the first half of this year. This is mind-boggling mismanagement. The risk-adjusted returns are de minimis on this, but it really forced the regulators' hand. So in a way, the bigger the screw-up, the bigger the rescue package.
Indeed.
It is a very complicated and perverse world.
Well, speaking of complicated and perverse, let me ask you one last thing, Henny, and that is that we have heard many people preaching for years that all we need is to get the government off our backs and let the market do its thing. It's dynamic, it's active, and that will lead us to prosperity. Now they are desperate for their very existence on government bailing them out of the pickle they found themselves in. My question is, does Wall Street understand the definition of the word chutzpah?
Save us from ourselves, right?
Well, I mean, there's a heck of a lot of unmitigated gall happening down there these days. Wouldn't you agree?
Absolutely, absolutely.
Yeah,
and it's amazing to me to talk to hedge funds who say, we used to short sell, but this is crazy. Save us from ourselves.
Henny, as always, good of you to join us tonight from New York City. We thank you for helping us better understand the mess you folks are in right now.
I'll buy Canadian dollars.
Amen.